Welcome to Lesson 7. Up to this point, we've used Fibonacci and waves to build our roadmap. Now, we need to look at the engine of the market, candlesticks. Candles aren't just colored bars on a screen. They are data-rich packets that tell us exactly who is winning the battle between buyers and sellers in real time. Today, we're going to learn how to decode them using the TI system. For those new to trading, a candle represents price movement over a specific period, whether that's 1 minute or 1 month. Every candle has four key data points: open and close. These form the body. In a green, bullish candle, price opened at the bottom and closed higher. In a red, bearish candle, it opened at the top and closed lower. High and low, these are the shadows or wicks. They show the extremes, the furthest price traveled during that period before being pushed back. Think of the body as the conviction and the shadows as the rejection. In the TI system, we don't just look at the color. We use a coding system to identify market intent. We divide the entire range of the candle, from the absolute high to the absolute low, into three equal parts, numbered 1, 2, and 3. Sector 1, the top third, bullish territory. Sector 2, the middle third, uncertainty/neutrality. Sector 3, the bottom third, bearish territory. By coding, where a candle opens and closes within these sectors, we can mathematically determine who is in control. Let's look at extreme candles. These occur when the open and close happen in the same sector. 1-1. Price opens and closes in the top sector. This shows a massive rejection of lower prices. Buyers stepped in aggressively. 2-2. This is a neutral candle. Price stayed in the middle. This represents a standoff. No one is in charge. 3-3. Price opens and closes in the bottom sector. This is a massive rejection of higher prices. Sellers are dominating. When you see a 1-1 or 3-3 at a Fibonacci level, it's a high probability signal that the liquidity flip is happening. Next, we have climber candles. These are your momentum builders for a move upward. 3-1. This is full market control. Price opened at the bottom and closed at the very top. This is the strongest bullish signal. 2-1. Buyers took control during the period and finished strong. We expect the price to continue rising. 3-2. This is a deceptive climber. While green, the price closed in the middle sector. Buyers were in control but lost momentum by the end. We treat this as a weak or useless candle for trend confirmation. Conversely, escaper candles show us the strength of a move downward. 1-3. Total capitulation. Sellers opened at the top and crushed the price to a close at the very bottom. Full bearish control. 1-2. Like its bullish counterpart, this is a useless candle. Sellers were winning but lost their grip, closing in the neutral zone. 2-3. Sellers started in the middle but finished at the bottom. This shows momentum is shifting in favor of the bears, and we likely see lower prices next. To summarize, the coding tells the story. A 1:1 candle is a pin bar or hammer, a sign that buyers have reclaimed the floor. A 3:3 candle is a shooting star, a sign that sellers have hit a ceiling. The 2:2 candle and any close in the second sector represents the sector of uncertainty. Professional traders avoid making big decisions when candles are closing in Sector 2. We wait for the market to move back into Sector 1 or 3, where the conviction is clear. Finally, we can identify a trend by comparing just two candles using their middle point. Uptrend. If the middle point of the current candle is located higher than the previous candle's high point, the momentum is clearly bullish. Downtrend. If the current middle point is lower than the previous candle's low point, the bears are in full retreat. Flat, choppy. If the middle point falls within the price range of the previous candle, we are in a flat or sideways market. Using the midpoint filters out noise and tells you if the trend is actually moving or just breathing. This is the final piece of the puzzle before we look for our entries.